So welcome. My name is Michael McCloskey. I'm the founder of GreensKeeper Asset Management. And this is our first Zoom town hall. We typically have our annual meeting in the summertime where people get together in my hometown of Mississauga. This is the first time we decided to do an online one, which has been helpful because we've gotten interest from people just outside of the GTA and clients that don't live near where we are. So I'm excited to give you an update on the business. What I'm going to do today is talk a little bit about our last year's results. Michael and I, my colleague Michael Van Loon, who's on the call with me, we're going to walk through a few stock examples. For the interest of everyone on the call, we're going to record the session. There are people that weren't able to attend tonight, but they wanted to see a copy. So we are going to post this online. And after talking about the portfolio, I'm going to give a brief introduction on GreensKeeper for non-clients. We have quite a few clients on the line, but quite a few prospective clients as well. So I'm going to talk very briefly about the firm, and I'd say to them towards the end, I'm going to give you our information. And if you want to have a private conversation after and get into a little bit more detail about the firm and your specific situation, we'll give you an opportunity to take down our information and set up a call with us. So after Michael and I go through our portfolio, a few stock ideas that led to our returns last year, we're going to open it up for Q&A. So we're going to leave everybody muted for the time being, but at the end, we're going to open it up for anyone to ask any questions. You'll be able to ask a question on video. If you prefer, you can use the chat function in Zoom. And even while I'm presenting, I won't take questions until the end. But if you have any questions that come up as we go along, feel free to throw them in the chat, and we'll make sure towards the end that we go through and cover what's been asked. So with that, if you just give me a moment, I will share my screen with you and we can get started. Okay, I think we're good. You can see the screen all right, Michael? Sharing properly?
Yep, you're good.
Thank you. I'm always asked about the firm name, GreensKeeper, and where does it come from? And yes, while I am a golfer, that's not where the name comes from. We're value investors, and the name of the firm actually comes from a quote from a famous value investor that was based in New York City, Christopher Brown of Tweedy Brown, who said value stocks are about as exciting as watching grass grow. But have you ever noticed how much your grass grows in a week? And so value investing works, and yet only 5% of the investors in the world actually use it. You know, Charlie Munger, Warren Buffett, they teach you how to do it, how to make your portfolio grow without taking a lot of risk. And yet, so why is it that only 1 in 20 people in the world actually does it? And the conclusion I've come to is it's temperament. Michael and I are wired a certain way where we have the discipline to do the work that's required in value investing. We have the patience where we don't need to be trading every day. And I think in our society of social media, people have very short attention spans. We actually think it's exciting getting to learn about businesses, even though we're not trading the portfolio every day. We're constantly learning about new industries and looking at new opportunities. And that's exciting for us. And so I think fundamentally, even though it works, I don't think most people have the right temperament to do it properly. And that's why it's not properly used, but it works. And we're going to get into our results. So my background, I graduated, it's hard to believe, 30 years ago from Western University. I studied mathematics, and then I did a dual degree. I did an MBA, business degree, and a law degree. And then I worked on Bay Street for about 15 years, first as a partner at a major law firm, and made partner, and then pivoted. I put my MBA to work and acted as an investment banker for almost a decade at Cormark Securities. And so in those 15 years on Bay Street, what I really learned was how the world works, how business works, and boards and corporate governance. But I also learned about the securities industry and capital markets. And research analysts, when they publish a note saying that a stock is a market perform or a hold, they don't want to say sell because of some of the tensions that exist in the industry. So it really opened my eyes to how capital markets really work, what the incentives are in the industry. And it also gave me a great opportunity to interact with a lot of portfolio managers and see what worked and what didn't work and what actually happens behind the scenes. And so after 15 years on Bay Street, I decided to do something different. I started managing my own capital. And then my brother and sister gave me their portfolios to manage, and then a few friends, some of whom are on the call tonight. And so that's the reason that I created the firm, was really as a vehicle to allow others to invest alongside me and my family. And we're going to own the same stocks and invest the same way. And so I just wanted to create a vehicle for others that wanted to come along with us on this journey. And we started that, I guess it would have been over 14 years ago now, with a whopping 3 million in assets under management. And as of the end of last month, I think we were 167 million and continuing to grow very, very quickly. And of course, as the firm has grown, so has the team. Rob McMullen joined us last year as our Chief Revenue Officer. My brother James has been working with the firm part-time since inception, helping me with sales and doing what he does. Michelle Tate, I'm sure a lot of the clients who are on the call are familiar with Michelle. They probably interact more with her than they do me. So Michelle handles client inquiries. She helps onboarding, transferring securities in from another dealer. If a client needs an RSP contribution or their annual RIF payment, she's the go-to person. In addition, behind the scenes, she helps me and Michael on the compliance side of the firm, helping us with trading and a lot of administration around the firm. And Michael Van Loon, who you'll hear from shortly, has been with GreensKeeper almost 2 years full time now. After spending a summer as a graduate student of our summer program, he's an Ivy graduate from Western University. And Michael is currently in level 2 of the CFA. We fully expect he'll be registered as associate portfolio manager later this summer, and as a full-time portfolio manager 2 years after that. So Michael and I are the two that work on the portfolio day after day, and you're going to hear from him and from me a little bit about our portfolio in a little bit. Before I go on, just one thing I want to say that most of the people here on the slide are clients of the firm and have their entire portfolio here. In fact, 3 of them have their parents have their portfolio here as well. So, we take it really, really seriously. And when you're managing money for the people you love and care about, I mean, it doesn't guarantee that your results, but it guarantees that you're gonna focus on it and take it really, really seriously. And we do. And I have 100% of my network or personal assets, my portfolio invested alongside the clients. And in my case, it's about 76% of my personal net worth. So I think that we have all aligned our interests with our clients and view the relationship as one as partnership. And so why does GreensKeeper exist? As I said, the only reason GreensKeeper exists is to make money for our clients while protecting their capital. I want the firm to grow. I want your assets to grow at an attractive rate, but I also want to protect the downside for my own capital as well. And so this is our lodestar, and we continue to focus on this. And provided that we keep doing this day after day, our firm will continue to grow and thrive. And so how have we done over the last 14 years? Well, we've only had one down year in our existence in 2022. And ironically enough, that was probably one of our best years. The market in 2022, if you recall, the S&P 500 was down, I think, about 18%. The NASDAQ was down 30%. I believe the TSX was probably down 20%. So that's a function of the quality of our portfolio. It's the quality of the businesses that we own that we're going to get into. It's applying a value investing methodology and buying them when they're cheap. And again, just bringing that discipline day after day after day and being really thoughtful with a portfolio. The other thing I'd say is on the chart on the right-hand side. So people that have been with us right since the beginning, if someone entrusted $1 million to us when we started the firm, it would be worth 3.84 million as of the end of last month. So it's quickly approaching $4 million. So over this 14-year period, we've compounded our clients' capital at 10.7% a year net. And I'd point out that all the figures here, we're very transparent about our returns. And I don't think you can say that about a lot of our competitors. They're on our website. And the second thing is when we post our returns, these are all net of fees. So these are the actual returns that our clients have received. And again, there are others in the industry that will post certain returns before fees to try and make themselves look good. We're trying to put ourselves in your shoes to say what exactly have our clients received, and we're very transparent about that. And so we're going to get into a few stocks, but I just want to give you a quick snapshot of the portfolio as of the end of last month. The first thing I point out is the bar chart on the left, of the blue bars. If you look at the makeup of the S&P 500 or the TSX or any world index, our portfolio does not look like any stock market index, nor was it intended to. So I'm not interested in trying to mimic the S&P 500 or the TSX or any other index. Michael and I are going to pick 15 to 20 of our best ideas. And the portfolio composition is a function of the opportunities that we find each year and as we're adding or detracting stock from the portfolio. So it evolves, but we're not trying to make it look like any index. We're trying to make money for you and ourselves. We're trying to do it as quickly as we can while still protecting the downside. And the second thing I'd say is that the chart on the right is where we invest geographically. So as many of our clients on the call will know, historically, we've been very heavily weighted in the US, and we still are today at just under 80%. And that's not because of some grand strategy. We go to where the great businesses in the world are. And the reality is most of them are domiciled in the US. But clients will also notice that our mix has changed over the last year, whereas I think over a year ago, we were probably closer to 90%. But over the last 12 months, the opportunities that Michael and I have found were actually outside of the US. 15% of the portfolio today is based in companies domiciled in Europe and the Middle East. So we added an Israeli company that we're going to talk about. We added a UK company. Two of our luxury names, LVMH is based in France and Richemont is based in Switzerland. In Canada, we have about a 3.9% position, which is pretty close to Canada's GDP relative to the world. And that's gone up recently because we added a name that Michael's going to talk about shortly. We've got about 2.2% of cash. But again, we prefer to keep the portfolio almost always fully invested at all times. So in short, where do we invest? We'll go to where the opportunities are. We'll go to where those great companies are domiciled. And when we find them and they're cheap, as long as that jurisdiction respects the rule of law. And so what that means is we're happy to invest in Canada, in the United States, in Australia, in New Zealand. I'm not interested in investing your capital or mine in a jurisdiction where we can wake up and with the stroke of the pen, the government has taken our assets or changed the rules of the game, places like Russia or China or India. So we stick to jurisdictions effectively in the West. And this just gives you a snapshot of the top 10 names in our portfolio, which would be more than 50% of our portfolio. And I just wondered a couple things. First, these are all amazing businesses. You're probably familiar with many, if not most of them. I would suggest that you probably put money in our client's pocket today by using your Visa card or American Express card, or I'm sure that almost everybody on the call used Google at one point this week. And so we look for these great businesses. And there's another common denominator between all these businesses that they have a sustainable competitive advantage where they've been great businesses in the past. They're great businesses today. And we believe they're going to continue to be great businesses in the future. And what that means is attractive economics, high returns on capital, and they generate cash. They all generate a tremendous amount of free cash flow that they can use to pay dividends, to buy back their stock, to make acquisitions, and to grow their business. So the quality of the portfolio is really what helps us to grow our portfolios, but it's really when markets get ugly that our portfolio has tended to shine. And so one of the questions I was asked by a participant on the call before the call was, recall we did 23.6% net last year to our clients. Well, how did you do that? What were the stocks that provided most of that return? So Michael and I did some analysis and we broke it down. And you'll see that American Express and Fiserv and Visa are three payment-related names. We're all big contributors to the portfolio. Berkshire Hathaway added about 4.63% to the portfolio. The Berkshire has been a holding of the portfolio since day one, not just because we are big fans of Warren Buffett and his style and Charlie Munger, but because we thought it was a good investment. We think it'll continue to compound at probably high single-digit rate. We're not adding to it here. So, word of caution that just because we like a particular name doesn't mean we're buying it at current levels. But it's a great business and a big part of our portfolio. Alphabet or Google was our third largest contributor last year. And as I said, these are global businesses. They may be based in the US, but effectively they do business all over the world. And then you get down to some of the smaller positions or lesser known names. Automatic Bank Services Limited, we're going to talk about tonight. You probably never heard of it. Lululemon. Most of the people on the call tonight are Canadian, so you'd be familiar with that stock. Michael's going to talk about it. So these have all contributed to the portfolio's returns last year. But of course, we weren't perfect and we had some laggards. And so this is the balance of the portfolio. These are all the names that we owned as of at one point during 2024. And so our defense names, Lockheed Martin, General Dynamics did not do as well last year, even though they had a stellar year the year before. Hershey, it was flat. LVMH was effectively flat. We bought it quite late in the year. And then our worst performing stock was Elevance Health. It detracted about 65 basis points from our returns last year. So I'd make a couple comments about this. First is in any one year, it's all it is one trip of the earth around the sun. Businesses can have ups and downs. Sometimes a business can do really, really well, but the market doesn't recognize that the business is doing well. So we take a longer term approach. But the second thing I want to say is when you look at our winners versus our losers last year, our laggards, a big part of what we do to mitigate risk is position size. When Michael and I see an opportunity of a great business that we think is very well priced, we're prepared to make it a big position in the portfolio. When we have other situations where we like the stock, we think it's perhaps not as undervalued. It's still undervalued, but it's not as attractive as the other. We tend to make it a smaller position. Or if there are more risks associated with the business, we tend to make it a smaller position. So it's a combination of the quality of the businesses we own, but also it's the portfolio construction that's helped deliver our returns while mitigating risk. So before I turn it over to Michael, I want to just talk a little bit about what we do and how we do it. And this is Buffett 101. There's a famous value investor out of China named LULU. He's the only investor outside of that Charlie Munger has ever entrusted his family money to. And he's got terrific returns. And he was asked a couple of years ago on a podcast, how'd you do it? And he said, easy. I studied Warren and Charlie and I did that. So it's amazing that if you've read back to what Buffett and Munger have been writing since the 60s and 70s, and Michael and I have read pretty much all of it, they give you the roadmap. All you have to do is have the discipline and the temperament to implement it. Circle of competence. When we're investing in a business, do we actually understand the industry? Do we understand the risks? Do we understand how they make money? And a big part of investing is there are certain companies that I can't understand. They're just too complicated, or they're just too many risks, and we can't predict what it's going to look like in 5 or 10 years. And so we stay away. And so that's the first gate that we have to get through for an investment to be suitable for us. Secondly, is wide moats. We want to buy businesses with sustainable competitive advantages. Capitalism is brutal, and you can have a business making amazing returns. NVIDIA is a good case. Everybody is trying to come after NVIDIA and design a chip that will try and erode their competitive advantage. And whether or not they can do it, I don't know. I don't have conviction that they're going to be a market leader in 10 years. They might be, but I don't have conviction. So we're looking for those businesses where we have a high degree of certainty that they've been winners in the past and they're going to continue to be winners going forward economically. And third is margin of safety. I mean, that's Ben Graham 101. We're going to buy these great businesses when they're cheap. It isn't difficult for Michael and I to identify the great businesses. We've shown you a few of them. That's the easy part. The hard part is getting an opportunity to buy them when they're cheap. And when that happens, it doesn't happen very often, but when it does, you have to understand why and you have to be ready. And so what we do is spend all of our time reading and studying, putting hundreds of stocks through this filter, and then waiting for our opportunity to buy them. But with that, I'm going to turn it over to Michael, and he's get into a little bit more detail about how we actually go through that process.
Hello, everyone. I'm Michael Van Loon. I've been an analyst at GreensKeeper for about a year and a half now, a little longer if you count the summer I spent here as an intern during my university days. I've really been enjoying my time here so far, and I'm looking forward to a bright future ahead. Now, to continue the discussion of our research process here at GreensKeeper, I'm going to walk you through a little flow chart that lays out the investing algorithm that we sort of use on a day-to-day basis. So the first thing that we look for is companies who appear to be compounding their intrinsic value consistently over time. And we believe that by working with an opportunity set of companies who are growing their earnings per share at about 10 or 15% per year, that we can be a lot less reliant on trying to time the market or identify the exact bottom of a stock's price while still generating phenomenal returns. If a stock looks like it has the potential to consistently compound, we then assess a company's moat. Warren Buffett coined the reference to a moat in investing, and he was really referring to a company's ability to protect its long-term profits and market share from competing firms. We also find that moats such as a network effect, high switching costs, durable competitive brands, they often give company's pricing power. And we find that this makes it considerably easier for us to forecast their margins and cash flows years out into the future. We then continue to sort of narrow down our investment opportunity set to companies that have strong returns on capital, which do not carry dangerous amounts of financial leverage to do so. We've often seen in the past that even if a company does have durable competitive advantages, that carrying excessive debt can be catastrophic to the equity holders of a company, which is us, when they are faced with unexpected events, such as a financial crisis, a war, a global pandemic. And for that reason, we really tend to avoid companies who cannot quickly and easily repay their debt obligations. Next, we look for management teams who really have a history of shareholder-friendly capital allocation. Oftentimes, we see management teams can become much too focused on hitting Wall Street targets, and this can kind of cause them to allocate capital poorly in an effort to prop up their short-term results. And we find this usually comes at the expense of long-term returns, which is what we are looking for. So we find if we can't really trust the management team to allocate capital responsibly, then we just aren't really prepared to own its stock in general. And then finally, if a company passes all of these tests, we try and determine what price we can purchase its stock, where we will achieve an attractive return on our capital, along with an adequate margin of safety. If a stock is trading below this price, we will buy it. And if it's not, we simply really have no problem with just adding it to our watch list and waiting patiently to hopefully get the opportunity to purchase it in the future. I'm now going to walk you through one of our more recent investments, which illustrates much of this process. I'm sure many Canadians are familiar with the company on this slide. Lululemon, they opened their first store here in Vancouver, British Columbia, I believe, around the turn of the century. And afterwards, they very quickly built a bit of a cult following with yoga enthusiasts across the country. Since its founding, they've expanded into men's clothing, which I wear all the time. I believe Michael does as well. And they've opened stores all across the world in many countries, the United States, many European countries, all across Asia, making them now really one of the largest athletic apparel brands in the world. So you can see from some data here, Lululemon, they have an incredible track record, growing sales and earnings over 20% per annum over the past decade. Average return on capital throughout this time has been 56% when you exclude the excess cash that sits on the company's balance sheet. Currently sits around $2.2 billion today. And really remarkably, they funded this expansion using internally generated profits and practically never took out any long-term debt. You can quickly see that this passes the majority of tests in the investment algorithm that I just walked through. So why did the market offer us an opportunity to buy stock in a company with this kind of track record at a price where value investors like us found it attractive? Well, after the company reported their 2023 earnings results, their management team forecast growth around 10% in 2024, which was a considerable slowdown from its historical pace. And following this announcement, took place March of last year, the stock price really took a nosedive. I think it fell about 47% from its peak to its trough while we were researching it. And we believe the reason for this was that the market took it as a sign that Lulu's moat, which would really allowed it to achieve its industry-leading margins while growing at such a rapid rate throughout history, was weakening really due to the entrance of a few new upscale brands that were gaining a bit of attraction in the athleisure space across America. However, in our opinion, the market was really extrapolating the short-term sales forecasts much too far into the future. And the company was really dealing with a temporary execution issue in its spring and summer assortment, which was unlikely to cause sort of a long-term change in its customers' loyalty to the brand. During our research, we found that Lulu replicates many strategies that have worked sort of continuously for the best retail brands in the world. They control their customers' experience by selling directly to them through their own channels. They never openly discount their clothing or advertise any sales. And management has really shown its ability to nurture and preserve the brand's positioning in the mind of its customers over decades. In addition to this, their success in the international market really opens the door to years of growth at profitability levels that have been shown to be roughly equal to the North American market. So, with so much room to continue compounding its earnings in a business with great economics, very clean balance sheet, we thought that we had more than an adequate margin of safety, and we started a position in the company after we finished our research process towards the end of September 2024. Following an earnings report a few weeks later, the market generally agreed with us, and since then, Lulu has generated a meaningful sort of return for the portfolio through Q4 and then the start of this year. So now I'm going to turn things back to Michael to discuss another one of our recent investments.
And this was a bit of a story. So I'm going to talk about one more stock and then I'll open it up for some Q&A. This is Peter Thiel, and he wrote a book called Zero to One. And he had this great line said, competition is for losers. And I love that line. Michael and I love investing in monopolies and oligopolies. We may not love them as consumers. When you go into an airport, there's only one or two people competing with each other, so you pay $8 for a bottle of water. But these are amazing businesses with pricing power. They have all the things we're looking for. And so, interestingly enough, this is the story of Automatic Bank Services Ltd., or SHVA. It's known by its ticker SHVA. I suspect almost no one on the call knows anything about this company because I didn't. I know a lot about payments. I've studied payments for a long, long time, and yet I'd never heard about this company. I was at a conference that I go to every year in Switzerland about 2 years ago, and a friend of mine who lives in Israel told me about it. SHVA is the Visa of Israel. When an Israeli consumer uses their credit card, the message has to go to the merchant's bank, goes to the issuing card, the card issuer bank. The message goes back and forth through the rails. And normally that goes through Visa and MasterCard, but in Israel, for historical reasons, SHVA are those rails. It's a monopoly. It's a government sanctioned monopoly. So first of all, it's a good business, and you can see its revenue increasing over time. The company had, a few years ago, 45% operating margins. It's not quite as high as Visa, but it's pretty close. That's an amazing business. You can just see it's a good business. But what was interesting about it was there was something happening. It was changing. And the government was trying to create competition. They didn't want to have monopoly. They would rather have competition in the marketplace. And so they were trying to encourage Visa and MasterCard to come into the market. The company was originally owned by the banks, the Israeli banks. And if you know your history of payments, if you look at Visa and MasterCard in North America, it was the same thing. Those businesses were originally owned and started by regional banks, run as not-for-profits, and eventually they were spun out as public companies. When you spin a company out as public company, then the market action takes place. You have a management team with incentives to grow revenue as opposed to just run it as a not-for-profit or on a break even. So you're going to see the market take advantage of what a great business it is. And so we knew it was a great business, and yet at the time we were looking at it, it was interesting. Their margins were coming down. So it's a complicated story. It's not well known. It's a $300 or $400 million market cap company in Israel. Visa and MasterCard ultimately decided not to compete. They ended up buying a stake in the business. By law, once the company went public, no person or company is allowed to own more than 10% of the business. So 4 of the banks that originally own it are at 10%. Visa and MasterCard bought another 10% each. They're not going to compete. So it's a very small public float. But for a company like GreensKeeper running $167 million of capital, we can invest in a business like this. But what was happening was revenues were growing, but margins were coming down. So when we dug into it, I came back from the conference. Michael and I did a lot of work. We had a call with management. the company's statements are in Hebrew, first of all. Now they do publish English statements, but that's 2 weeks later. So we're using Google Translate to try and figure out the numbers. It takes a while, so it's a little complicated. You have a company in a small country. It's not well known, and because of the separation of the spinoff, the company also was forced by the government to separate from, let's call it, a sister company that did some of the bank settlements. And when that happened, what SHVA was forced to do was add redundant servers. You've got two companies that were sharing resources that are now separate. So they had to spend a lot of capital. They had to hire people to get back and run as a separate company. And so you saw that weighing on the earnings. And for that reason, we were able to buy this company at 10 times earnings. It had no debt. It had, I think, $100 million or 100 million shekels, I forget, on its balance sheet at the time. Amazing business. And we're buying it at 10 times earnings net of cash. Of course, we like when Michael talked about buying Lululemon, we bought it and we're within months up 50%. This one was different. As soon as we bought it, a war broke out within the first few months. So oops, our timing was horrible. So we were probably down about 15, 20%, maybe a little more on the position. But we continued to monitor it. And the thesis started to play out like we thought. Management ended up raising price. You're a monopoly. You have increased costs because of the government forced separation. So you raise costs to compensate. And so we're starting to see their margins starting to tick back up. The war will end someday. I don't know when. It looks like hopefully we're coming to the end. But the business volume should continue to grow with the Israeli economy. So after a year of seeing the stock do nothing, we were slightly down on our position. Michael and I effectively re-underwrote it. We had another call with management. We talked to other shareholders. We did additional work. And we decided no, like the business was as good, if not better, with the exception of the macro environment because of the war that was happening. And so we decided to double down and we added to our position. And that was about September of last year. And as soon as we did that, the stock started creeping up and we bought a little bit more and then we stopped. We didn't want to chase it. So we didn't get our entire position. We got most of it. And it's been, since then, it's doubled in the last, I don't know, it's 2, 3, 4 months. So my point, I mean, it's an interesting story to begin with, but when we find a situation, an amazing business that checks all the boxes, we do our work, sometimes the market over a year, if you looked at the year from the time we bought it till we bought it the second time, we were down. I would argue the business was even more undervalued the second time. So we don't look at a scorecard on an annual basis, but I can't tell exactly when the market is going to agree with us if our thesis is correct. But if our thesis is correct, eventually it will. And that's fundamentally what value investing is all about. I didn't think we were taking much risk, and we've had an amazing result. Okay, so I'm going to open it up for questions momentarily. But again, I had a few people send me questions in advance, so I'm just going to start off with a few of those. First, Jody asked me, what is the forecast for 2025? And what I'd say is, what I always say is, do you have a coin in your pocket? I have no idea what the market is going to do over the next week or month or year. And I think that the people on television who are telling you that they don't know what they're talking about. But what I do know is you can study markets over longer periods of time. Whoops. This is a great chart of the market over the last 150 years. And the real takeaway from this is it depends on your time horizon. If you look at the market on any given day, the probability that the market is going to be up is, I think, about 56%. So it's a little bit better than a coin flip. If you take that out over the course of a year, it's 69%. So you got about a 70% chance in any one year that the market is going to be up. Now, if markets have been, like the last 2 years, they've been very, very good, I'd say that probability is probably a little bit lower, but it's still over 50%. If you go over a decade, the market is up 80% of the time. So my point is, don't try and time the market. Markets do this over time because companies retain their capital and continue to grow their earnings and raise prices. It's a fantastic game for your savings. You want to be invested as long as you possibly can. And if you can apply a value investing methodology that even reduces risk, you can try and mitigate some of the downturns that happen from time to time. But I'd say that the secret to investing is to just be in the market, continually be in the market. Second investor asked me, how would you rate our opportunity set as compared to recent years? And what he was, I'm going to rephrase it a little bit. He's really saying, like, how many opportunities are you getting today? How many do you see? How many great opportunities? And the reality is, the market's probably fully valued today. There are pockets of froth and there are a few things that are kind of interesting, but I'd say in general, I see a lot of speculation, whether it's Bitcoin or the Trump or Melania coin, or we've had these meme stocks like GameStop. And, a few years ago it was marijuana stocks, which have generally end very badly. So, that is the general market environment. But regardless of that, the late Peter Cundall, famous value investor from Canada, said there's always something to do in any market environment. Michael and I, there are stocks out there that are undervalued that check all of our boxes, and our job is to find them. When markets are expensive and getting expensive, it's harder. But so what? We just have to continue to work harder to find them. It's not like it was in the dot-com era in, March or April of 2020 or 2008, where it was shooting fish in a barrel. There were amazing companies being given away. It's harder today, but that doesn't mean that there aren't value stocks out there that are mispriced. And our job is to just go and get them. Thoughts on cryptocurrency. So from my prior slide, you can probably tell my thoughts on it, but I'd say this for anyone in the audience who actually owns it. What's it worth? When I look at a stock, an American Express, a Visa, I can look at how much cash flow that's going to generate. And in my opinion, the value of any asset is the cash flow that it generates for its owner over its useful lifetime. With cryptocurrency, the only cash flow you're ever going to get is when you sell it to someone else. I don't think it has any intrinsic value. Now, if someone wants to put 1 or 2% of their portfolio into cryptocurrency and hold it, so be it. I don't have a problem with it. I'm not interested in doing that with my money. I don't think it can be valued. And so, I just go back to what Munger said. It's remarkable how much long-term advantage people like us have gotten by consistently trying to be not stupid instead of trying to be very intelligent. If something doesn't make sense to me, or I think it's foolish, we just ignore it. And Michael and I don't need to invest in every situation or have an opinion on everything. We just need to find 15 to 20 high quality names that check all of our boxes and are purchased at an attractive purchase price. We're looking for what Buffett used to say, 1-foot hurdles that you could step over, just obvious situations. And finally, last question that was pre-submitted, investing in new ideas versus increasing the size of your current holdings. And this is actually a really sophisticated question, because Michael and I, whenever we're looking at a new name now, we haven't bought it yet, but we might buy it tomorrow. If a client is fully invested and we don't have any cash, we're gonna have to sell something. And so the real question is this new name that we're proposing to put into the portfolio, do we like it better than something already in the portfolio? Because if it's not better than something we own, we should just add to something that we currently own. So investing is all about opportunity costs. Whenever we're looking at a situation, money is always coming into the fund, or people are topping up their RSPs. What do we like the least in our portfolio? And then if we're looking at a new situation, is it better than the thing we like least? That's the mental math that we need to do every day as we construct a portfolio. So as I said at the outset, I promised you my contact information. For non-clients who may be interested in setting up a call with me, I'd encourage you to pull out your phones and take a picture of this. Even if you want to take the QR code, it'll input my email into your Outlook or your email software. And now I'm going to open it up to questions. But thank you for your time, and I'm going to stop sharing my screen. You can ask a question either in the chat, or I'd encourage you to put up your hand. And I think there should be a button. Bear with me, called React. If you look at the tools on Zoom, there's a button called React, and you can use that to put up your hand so that we can just take one person at a time. So if you just give me a moment, I will unmute microphones and get set up here. So bear with me, please. Go right ahead, please, Adam.
Hey, good evening. Thanks, guys. Appreciate the update. Potential client here
Great.
from Texas. Yeah, I always enjoy reading your reports and your insights. Just in light of some of the current events, maybe any comments on the current potential for tariffs and how that might affect things for you guys and how you approach things?
Yeah, it's a good question, Adam, and we're thinking about it about 28 hours a day at present. So the reality is, if you look back about 4 or 6 months, maybe 4 months ago is more accurate. We were already looking at the polls. We knew it was close. Trump, it was clear that he was going to impose tariffs if he won, and there was a high probability, or at least a decent probability, that he was going to win the election. So what Michael and I did was we went through our whole portfolio. If he wins, and if he does some of the things that he's talked about in his policies or in his speeches, knowing that not everything's going to happen and Congress may not enact everything, what would happen? And so one of the things, just in the interest of time, that we didn't really get into with Lululemon, that was a risk. Will he put tariffs on a Lululemon? But our analysis was, where do they manufacture? And in their case, their tariffs were, I think their manufacturing was only 4 to 6% of their manufacturing was in China. A lot of it was in Bangladesh and Vietnam and other countries. But the reality is, no matter where you manufacture any kind of clothing or athletic gear, whether it's Nike or Lululemon, it's manufactured in Asia. So if Trump was going to put tariffs on just China, they were fine because they had other places that they could import from. But if he did it everywhere, every company that manufactures clothing or makes clothing, any clothing brand, is going to have higher prices. Lululemon skews, I would say, premium, where their pair of yoga pants are $90. So their customers are not wealthy, but they're affluent. So we thought, for all those reasons, that the business would be fine. It's not a good thing if he actually imposes tariffs. It's going to hurt their sales a little bit, but they're going to get through it, and it's fine. So we think about these risks. You got to think about them way in advance. And we're still thinking about them every day because of what comes out of the White House on an everyday basis, Adam. We're constantly thinking about the names that we own, or this other name that we're looking at tomorrow. We're thinking about, okay, what could happen? What are the pressure points in healthcare? So that's what we do all day, is we worry about your money and mine, and just think about how we want to be positioned. The reality, though, is it's difficult to hide. We have our firm is based in Canada. We have a lot of Canadian clients, and I've heard, Canadians are upset about the position that Trump has taken, given the country's long-term friendship. And I understand that. I don't think what he's doing is right personally as a Canadian, but I have to deal with reality. But the reality is that if he decides to put tariffs on Canada, Canadian companies are going to get hurt badly. And what I want to do for our capital is invest in a business like Visa, for example. Visa is an American company per se, but where do they sell their services? They're around the world. Lululemon is a Canadian company per se, but their sales in Canada is, I'll get the number wrong, but 20%. They've got tons of sales in Asia and the US. So most of the companies we own are global businesses. Some of the more US-centric ones, like a Berkshire Hathaway, they're going to be insulated from a lot of what he's doing because they're positioned in the US. So, I'm patriotic, but at the end of the day, you got to deal with reality. He's the president. He's going to be the president for the next 4 years. And there are going to be policies that are going to come in that are going to hurt certain companies and help others. And it introduces a lot of risk. And our job is to try and think about those risks and position the portfolio appropriately. We're going to make some mistakes, Adam, because there's unpredictability that's going to happen, but we're going to do our best to continue to be vigilant and just keep thinking about it. But the reality is, if you invest in these amazing businesses that are global and really good businesses, they usually have the ability to adapt. And so that provides another level of comfort for us, that they're going to figure it out. They may be hurt by some of what's happening, but they're not going to be decimated. So yeah, I hope that answers your question.
Thank you.
I have another question from Hakanori. Yeah, so the question effectively is, how much time do we spend on the existing portfolio companies, and I presume versus vis-a-vis any new opportunities? And the reality is we only own 17 to 20 names usually. And so we go deep, and we tend to own them for a very long period of time, usually somewhere between 5 and 7 years. As you own a company for a long period of time, you get to know it and its industries and its competitors much, much better. And so we spend a lot of time on our portfolio companies, but we're also studying competitors and adjacent industries and suppliers. And Michael and I read all day. That's effectively all we do. And so we're always coming across new situations. But keeping on top of what we currently own is a big part of what we do. I don't have an exact percentage for you, but it is a big percentage of our time. Have we ever sold a position because of uh, reasons other than finding a new buy? Sure, I've changed my name one or changed my idea on a few stocks over the years. Either the facts changed that there was new regulation, or I learned something new, or I saw a management team that did something that I didn't like. There was one company I can recall making a big acquisition and adding a lot of leverage, and I thought it was a dumb decision, bad capital allocation decision, so I just decided to sell it. So yeah, you got to be open-minded in this business. You have to continually learn, and you got to be continually vigilant. And I forget who it was. It might have been George Soros or someone said, you're a security analyst. He said, no, I'm not a security analyst. I'm an insecurity analyst. I'm always worried about things in my portfolio. And you have to have that mindset as a portfolio manager to always be thinking about, am I right? And when we looked at SHVA, the Israeli company I told you about, a year later, we could have come to a different conclusion that we were wrong. Maybe we learned something new, or management did something we didn't like. So if the facts change, we're going to change our mind. And we don't always talk about the stocks like SHVA. We didn't talk about SHVA for over a year because there was a possibility that we were going to sell it. And once you talk about it, you don't want to sell it because your ego's involved. But there was also a possibility that we're going to add to it. And I don't want to advertise what we're doing because it's a name that's difficult to add to our position. So, we try and give shareholders or clients transparency. Twice a year, they see the entire portfolio. They'll see the name, but we may not talk about it. So those are some of the decisions that we make, day in and day out. Are there any other questions? Okay. Well, I want to thank you all for being part of our initial Zoom conference call. I think we're going to do this again. And I'd encourage all of you to take a look at our website. If you're not currently a subscriber, I know Adam is, so thank you for your kind words. GreensKeeper.ca. You can sign up to our newsletter, which is free. Even if you're not a client or potentially have no interest in being a client, I think it's entertaining, and it talks a lot about personal finance. And a big part of what we do here is to try and educate people about personal finance. But if you would like to have a call, and Adam or others, please reach out to me, and I'd be happy to set it up, and we can have a private conversation. And we have one client in Texas, so hopefully you'll be number two. So I thank everyone for their time, and have a good evening. Thank you.